Hello, ladies and gentlemen. I would like to welcome you to this afternoon webinar. For those who don't know me yet, my name is Theo. I'm based in Europe, and I'm here to introduce you to your host today, Jens, and to pass it on to him. So just to make sure you all have downloaded the mobile application, our native mobile application, that where you can place your trades, you can monitor your account. It's really an awesome tool. I use it on a daily basis, multiple times a day, because it makes my trading journey much easier. Then to make sure that you are informed about the weekly podcast we do here at Admirals. Every Monday, I put on the website the podcast, and I talk about the news, the upcoming news events for the week. The most important actually for traders, especially if you're an intraday trader, you are aware of times and days of high volatility in the market, like the one we're going to have next week and the week after, with many major banks announcing interest rates. So it's good to have just a knowledge about what's going to happen during the week. Let me share with you the screen just to go through this for 1 minute. Here it's the YouTube channel. In case you don't know it, you are new with us, please make sure you like and subscribe the videos and on the channel, because the team is putting so much effort to bring out this content to you. And here is the link. Also, when you scroll down a little bit, you can see the trading spotlights with all of Jens' webinars recorded. You have the opportunity to watch them, to learn from him a lot. He's an exceptional and experienced trader, and I'm sure you gain a lot of value during these webinars. And also, if you want to participate in the live trading morning sessions, I do Monday to Friday. You are more than welcome. Here it's the times. And then we have the Admirals Instagram channel. Make sure you follow us on the Instagram, because there are a lot of valuable content coming on here in the form of stories and reels. So please make sure you follow us here, and you're going to receive all the notifications on Telegram. So it will be great if you just follow this page as well. And for those who are not familiar with us yet, here at Analytics, you can find the weekly trading podcast. You can listen to them as many times as you want. You can share them with friends and family, and you can download them on your mobile device. And the last one from me, if you want to participate on the webinars and you don't know yet where to find the other webinars we host, here at Education, the Forex and CFD webinars. Here is all for Jens. Here is the one I do on Monday to Friday for 30 minutes, and so on. Some scalping here, trading psychology, some series I launched recently. So you have variable knowledge from different traders here. But please allow me to pass it on to Jens. Hello, Jens. How are you today? The stage is yours.
Hello, Theo. Nice to be here. Thanks for the warm welcome.
Pleasure.
Yeah, I hope you're long equities right now.
Yes, definitely. What else?
Yeah. Massive short squeeze. And the great thing about this is that today is the day we will look at inflation. In fact, I have to be honest, I wasn't aware that inflation data was released the day before our event. So the plan was, yes, let's have some thoughts and theoretical thoughts on inflation, but it wasn't that I planned this. And in fact, it's an amazing opportunity now, not just to give some theoretical background, but also what's the current driver and what will will be the final result, most likely outcome of the price action, most recent price action. Shall I share my screen?
Definitely, absolutely. The stage is yours.
Great. So that means I also can say hello, yes, to everyone. Yes. 1 second. Yes, hello. Yes. So this is the chat box. This is where you can ask all your questions. And yes, as I already said, it's a great day to be here. In fact, I mean, I'm always very happy to be here. But today we will face a very important topic and also look at a very important topic when it comes to the current market environment. We'll look at inflation. Inflation in general is right now the most hot topic, and let's just dig deeper and dive into the action. So I don't think that I need to introduce Admirals anymore, or make sure that you will read the risk disclaimer. All infos can be found also on the website admiralmarkets.com. If we make any trades or if there's any setup, we will make a topic here. So I say this now because the reason is I'm not really sure. Well, probably we will find trading opportunities already today, and why we will see in the upcoming minutes. Please be aware that this is no financial advice. It's the complete opposite. It's purely educational content. If you make any trades or if you take any trades based on my thoughts, then please make sure that you understand that you're fully responsible for taking the risk. Do your own research, and it needs to fit your personal trading style, your way of trading, especially when it comes to the position size, risk, money management, and so on and so forth. I don't need to introduce Admirals anymore because all introduction details were already presented by Theo. So we will just here dig deeper into the question of today: what is inflation? And well, the thing is that this has been the topic, and it will probably be the topic of the upcoming weeks and months. And it's the most interesting topic right now due to its direct impact on the monetary policy approach, which we will see now. And after yesterday's release of US CPI data, you have probably seen numbers came in above expectation. We saw an immediate aggressive flush, as we will see, by the way, also in the chart in a few minutes, on the downside, due to the fact that the Fed is expected to probably be even more restrictive in her monetary policy approach in the upcoming months. In fact, as was already expected, but, and this is the big but in this context, the thing is that most of this restrictive approach or a restrictive expectation was already priced in. As we will see in a few seconds, we should expect the Fed not to be too restrictive due to the risk of a too restrictive monetary policy for the overall US economy. And probably we are also about to peak out in terms of inflation. And there's already first indications which point in this direction. And this is also something I will show you now. So, and that being in mind and knowing that markets anticipate the future, it's not that we are trading the current environment. Certainly there are certain drivers. Probably right now, it's not just inflation, which is the topic right now in this very moment, but probably the driver. Let me just check out here. I think, yeah, S&P is had 1% in the pre-market. DAX already or back again into positive territory with, I think, 200 points or something against the daily lows. Main driver seems to be that there were some comments from Vladimir Putin right now saying things like, well, wait a second. Where do we have it? I just read it before I joined the webinar here. So there's no need for massive strikes on Ukraine right now. Russia is not seeking to destroy Ukraine. 1 second, please. Okay. Russia is not seeking to destroy Ukraine. No regrets about Ukraine invasion. Our actions are right and timely. This is taking some tensions back from market participants, probably, who also sold, being scared about a potential nuclear escalation. But all in all, especially when it comes to the monetary outlook, monetary policy path the central bank is following in terms of inflation, it's the anticipation of the future, which is the main driver. And most of inflation fears were already priced in over the last months, in fact, also, which can also be seen in the way the central banks tackled this inflationary pressure, which we've seen here. And so now coming back to inflation. First of all, what we will do, I will introduce to you the concept of inflation, what it is. You've already probably read the slide, but I will go through the certain points. But then we will take these theoretical bullet points here and use them and paint or draw a picture we can use in our trading, also based on formulating trade hypothesis and why the market is currently reacting as it's reacting on the inflation print, which we've seen yesterday being released. So first of all, in economics, inflation is a general increase in the prices of goods and services in an economy. So when the general price level rise, each unit of currency buys fewer goods and services. And that being said, inflation erodes the purchasing power of a bond's future cash flows. So usually, well, what you will currently see is there is more money chasing fewer goods and more money. How could this be? Let's say in a normal environment, in an environment which is not driven by QE, but a classic environment, let's say a purely Keynesian model, for example, you can say, okay, if an economy, and this is something we already mentioned last week, or 2 weeks ago, I'm not really sure. No, 2 weeks ago, must be 2 weeks ago. Last week was the non-farm payrolls event. We talked about GDP, for example, and so if an economy, if there's a positive economic outlook on an economy, for example, and there's trust into politicians and their actions, and low levels of corruption, let's say, especially in politics, then you usually are willing to invest and build a company, and therefore you need best people available. And it's not just the vision you share, but if you have a great product which sees a high demand, usually you have a rising revenue, making more money, giving you an opportunity to pay higher wages for your employees, to make sure to also be attractive for the most the best employees you need to have to build an even more sophisticated product, which sees an even stronger demand. And there's a prosperous outlook for the overall future, which makes the employees saying, okay, I have more money, I spend the money. I spend the money on luxury goods, I spend the money on buying a house, buying a car, whatever, which is driving the overall economy. So now, that being said, you see that there is more money chasing the goods, and overall, which means, like, if you chase goods, that means that other companies are now motivated to invest and produce even more, and the same process starts to build up at another, let's say, area of the overall economy. So now there's more and more money flowing because banks have cheap liquidity and giving it to the companies so that they can invest. And that the problem now is that the economy is about to overheat. So overheating means that inflationary pressure, which is building up, is getting too hot, which means that the central bank then intervenes and hikes central yields. Rate hikes are the consequence out of this, which means, like, you make liquidity more expensive, which leads companies to say, well, we are not that profitable that we can afford more liquidity, which is then resulting in an economic downturn and the overall process with central banks starting to lower rates again, and then making sure that there's enough liquidity available, which can then be again demanded from companies, and the whole cycle repeats itself. So now the thing is that this is a normal cycle. The thing is that we are right now in a cycle which is mainly driven by disastrous decisions which were taken from politicians in terms of COVID lockdowns, for example. So what they did was they shut down the economy to try to how did they call this? Dampen the spread. I think dampening is the wrong word for this. So they wanted to somehow make sure that there's in some countries around the globe. In Germany here, for example, there were some well, not sure. They call them scientists. I'm not really sure if you can call someone a scientist who tries to hunt and catch a virus in this case, and make sure that there's zero COVID in this case. I'm not really sure if you can call someone like this a scientist, but however, the thing is that I'm shutting down the economy, especially in the current environment, and then making sure that there's still no social unrest resulting out of this shutting down the economy and keeping people at home. You still pump in billions of US dollar, euros, GBP, JPY, so on and so forth. And now you have lots of liquidity and people start to chase goods. So now the thing is the economy is shut down. So there's no products which the money can chase. Well, look at the chart. You will see when looking at the NASDAQ 100, for example, or the S&P 500, they nearly went vertical. The same is true for cryptocurrencies. The same is true for, well, you name it. Because the money was there, but people started to chase then these assets in this case, which drove prices aggressively higher. So now the thing is they revive the economy. Let's say the lockdown is lifted, and then people have all this money, and this is now chasing goods. The problem is that supply chain interruptions were caused by this, because certainly if there's no production taking place, and it takes some time to bring production back to the levels where we shut down the economies, we lock down cities and so on and so forth. Well, now you have supply chain interruptions, supply chain issues. And this is what I mean with disastrous decisions from politicians, because you can foresee that. That was clear that this will happen. Now you have lots of money chasing fewer goods, which is naturally resulting, driving prices higher, with an overall economy trying to gain momentum again. But, well, as you will have seen, and as we now see an acceleration taking place, companies realize, well, their products are not that competitive anymore, and so they start to reduce, for example, their labor force, their employees. Well, they just fire them. In addition to the fact that now central banks are forced to somehow getting inflation under control. The only problem with inflation is it's like you can imagine this like a bottle of ketchup, right? So glass bottle of ketchup, and it's like you probably have seen it or tested it yourself. So there was a time before we had these squeeze bottles, which can perfectly which can be perfectly used, for example, for French fries, all of that stuff. So you had these bottles, and you just shake them and shake them and shake them, and you hope that something will come out rather sooner than later. And then nothing happened, and then you had the blotch, and then you had all the ketchup on your French fries. So this is like you can call this a ketchup effect if you want, and this is the same with inflation. That's the same idea behind this. So there's no inflation taking place, no inflation. Everyone was talking about inflation. Well, we need to get inflation to 2% at a stable level. Boom, now you have inflation, and inflation is 8%. So this is like what's currently taking place, driven by the decisions taken from politicians in this case. And it was clear right from the start that this is not a transitory phenomenon, which we're getting to see here, because all the billions and trillions of USD, JPY, euro, pound sterling, and so on and so forth chase fewer goods. And you can't bring production levels to the levels pre-COVID in such a short period of time. This is just not work. This is just not how the overall process works in this case. So now you try to get inflation under control by hiking rates, making money expensive, and giving people here attractive yields so that they keep their money in the bank accounts, if you want, and gain yields on their savings in this case, and not pumping the liquidity into the overall process or into the economy, and trying to calm down or decelerate the velocity of the money which flows around. But the problem is that companies which were already working with quite low or based on low margins are now seeing that their overall business model is not profitable anymore, starting with marketing, advertisement, and so on and so forth. And thus you can see now that especially tech companies, especially growth companies who needed needed cheap liquidity over the years, and which prospered, let's say, or saw massive growth outlooks after all this cheap liquidity was pumped into the overall economies around the globe post-COVID and the lockdowns. Well, now the liquidity is getting extremely expensive, and they can't afford to fund their businesses anymore. They're shut down, which means like employment situation is worsening and so on and so forth. But coming back to inflation, all we currently see could have been, you could foresee it, in fact. And now, what you see here, simply speaking, the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand this higher yield to compensate for inflation risks. So coming back now to this chart here, what you can see that there's a direct correlation taking place. So we've seen that post-COVID especially, let me just see here. Yeah, this is the US Fed funds rate in this case. So 2.5%, that was in 2019. And then we already started cutting rates in July 2019, if I'm not mistaken. And this accelerated massively with all the massive QE taking place and all the quantitative easing post-COVID here, driving back yields to zero, holding yields at this level, while then inflation started to pick up when we revived the economy. Now you see this inflation pickup, and as you can see now, we are chasing here inflation. The thing is, now you have to be very careful. It's not that the current rate levels at 300 to 325 basis points is above the inflation, but right now inflation, as I already said, is at 8.2% in the US, while we are massively lagging here inflation yield-wise, especially when it comes to the Fed funds rate. But what you can see, and this is what this is about, you can see that we're chasing this blue line now, the inflation, which picked up massively. And so now, well, what we're currently seeing, what should be clear is that if you hike too aggressively in such an environment, which is completely understandable because you're punishing, in fact, with all this with inflation getting out of control, you're really punishing savers. For example, you punish them because now they are not getting enough yields to compensate for the diminishing purchasing power of their savings. In fact, and so that being said, and to minimize, especially the political impact this has, because people will start to rather sooner or later. Not really sure whether they will demonstrate for higher yields, but you get the point. So you frustrate people. And so the thing is now that you somehow need to hike rates, raise them more aggressively to compensate for the diminishing purchasing power. On the other hand, you need to be really careful, because if you're too aggressive with hiking rates, then this has a direct impact on the economy, because the liquidity is needed to keep, in this case, the engine running, in fact, the economy running. And you need to make sure that you're not making it too unattractive to invest, or unprofitable for companies to invest and keep their business going, and cutting their workforce dramatically, because then you have a rising unemployment rate, which adds fire to the fuel in case of a very high inflation. So this is like a balance act, which the Fed in this case has to go through right now. So now the question is there any chance that you can bring down inflation without hiking rates too aggressively? Well, certainly there is. For example, people will naturally demand fewer goods which they don't need to fund their overall living, or fund their living in general. So you will for example say, well, do I really need another streaming service like Netflix, and then Amazon Prime, and what do you have, Hulu and Disney Plus? Do I really need this? Or probably, is it okay if I have one, if I need one at all, and instead take the money and buy some food I can put on the table and feed my kids, for example? So that being said, and this natural tendency that market that you start to adapt, in fact, is the first driver lower. So there's less demand among market participants in the marketplace. This is the first effect, and it can already be seen. And this is the next slide I have here. So the question I have now is inflation about to top out? And in fact, as you can see, it is about to top out. So what I did here, this is a chart I have from tradingeconomics.com, the one before also. You have in black, the dotted line is the US inflation rate. And then in blue, I have, in this case, the US ISM manufacturing index. You probably have heard about this economic indication. And here, it's not the ISM, but it's the paid prices. So it's a subcomponent. And what you can see is that there is now already a sharper drop taking place, which is driving us. We're still above the COVID levels here, the blue line, but still, we've already come down quite massively. And you see that there is a positive correlation between paid prices and inflation rate, because if you pay lower prices, usually that drives inflation already down. And as you've seen here, we already peaked out at the middle, around probably the end of 2021, and now seeing a drive lower back to levels around 50 points, around year 55. And rather sooner or later, inflation will follow. And that having that in mind and seeing other indications, for example, that paid prices are already dropping, while you, for example, see that the situation in the employment sector is quite stable. Remember, last week we saw some solid numbers which drove prices in equities aggressively lower, and we made new yearly lows, which already saw a blow off then yesterday with inflation data. Why is that? Well, because the situation in the employment sector is still solid enough that you can expect the Fed to keep rates at an elevated level and not willing to take take the foot off the brake in this case, and make money more or cheaper in this case. Well, why? Because you can see that making money cheaper in the current environment is probably, it's too early, because the situation is not worse enough economy-wise and as employment situation-wise. So that being said, is one of the reasons why the market is currently reacting negative. In market, in this case, equities are reacting in a negative way on a positive data set, and vice versa. And so now, that being said, you can now see here that we have now the employment situation presenting itself quite solid. The paid prices coming down, employment situation is still solid, but there's some kind of a tendency that we could see a recession coming, not necessarily in the non-farm payrolls, but if you look at the JOLTS, for example. And then there's other indications, like, for example, today, there's another very important data set. This is a chart I will present in a few seconds. But here today, retail sales numbers were presented. So this is kind of the backbone of the US economy. In fact, I think 35% or so of GDP, US GDP, is retail sales based. So that being said, if numbers come in at 0 month on month, while they were expected to come in at 0.2 and 0.4 previous, well, this is like an economy which is cooling down, let's say, which is another potential reason why the Fed could then say, okay, we're starting to ease our monetary policy path we are currently on. And so now, all the theory, well, what can we do with this? And what has this to do with yesterday's strong rally? In case of this is the NASDAQ 100. Let's go to a 50-minute chart. So look at this sharp push higher here. So this was the initial flush lower. That was 8.2%. Inflation was released. And then you see this massive V forming here. And the market pushing aggressively higher and continuing to push higher here now. And the question is, why is that? What happened here? So the reason is that being said, that this development, especially inflation-wise, it was something which was driving prices lower from the start of the year already. So we started to already accelerate on the downside. We were quite hot, coming in quite hot around new all-time highs in the NASDAQ at the beginning of the year. And then we started to roll over. We saw a corrective move. And then the question was, well, did we see enough of a correction after inflation picked up slightly, expectations around a more restrictive Fed started to pick up? And then things started to escalate quickly in regards to the Ukraine and Russia, which drove us even more aggressively lower. The bounce then, which happened here, that was in March, in the 2 weeks following the Fed meeting back then, they resulted out of the fact that the rhetoric wasn't very restrictive for the upcoming months. And market participants started to anticipate a more a looser monetary policy approach from the Fed. Well, they found out, well, they won't lose their monetary policy approach, but instead they will be more tight over the next, more restrictive over the next month. Market turned lower again, making new lows. Then here, there was this inflation peak out with 9.1% in June, driving us to new lows. And then things started to turn a little. And then market participants said, well, now we are here at a level of something like 4% back then in terms of the expectation in December, what levels, rates wise, the Fed will present to the market. And this is just too restrictive. The economy is not strong enough for that. Back then, we already started to see that the first quarter 2022 had a negative GDP print. We saw another negative GDP print that was here in the first 2 weeks and in July, if I'm not mistaken. So we had now 2 consecutive months, 2 consecutive quarters of negative GDP growth, which is the definition of a recession. You saw an inversion of the yield curve, so 2 and 10-year yields representing themselves negative, respectively inverted, which means you get a higher interest rate on short-term debts, 2 years, than on 10 years, which is showing we expect the Fed to move aggressively higher with the interest rate, while we expect the economy cooling down longer term, which is why this is interpreted as an indication for a recession at the horizon. And then you saw this strong run into the summer months, into the mid of August. And then market participants realized, well, inflation is not coming down. Inflation is starting to pick up, respectively hold at a quite elevated level. Let's go here to the chart, inflation rate here. So you saw, well, there was this peak in June. Then we started to come down, but inflation did not come as quickly down as market expected it. And when market participants realized that there's probably more pain to come in terms of higher rates from the Fed, then we drove sharply lower again here in this case. And yesterday saw this potential blowout on the downside. And why do I say blowout? This is something that we will use now. We saw this massive flush lower yesterday and then sharply reversed. So how can we see what market participants were playing here, especially into the last run, especially here from June to mid-August, and what they were expecting a higher inflation rate? And why do we see now a potential blowout on the downside and a potential capitulation? How can we identify that? Well, first of all, therefore, we need to have a look here at the big specs, the big speculators in the Commitment of Traders report. And then what they do, or what you can see here, this is the lines we're looking at here. And we are looking at this green line. The green line here is the non-commercials or large speculators consisting of managed money, for example, and other reportables, CTAs, hedge funds. So people, or respectively institutional traders, who are betting on trends, bigger trends in this case. So now what you can see is we saw an interesting development here over the course of the first 6 months of the year. They were already coming in long. Certainly, well, there was a clear long and bullish bias following COVID and here the March lows in 2020. So they were on the long side, being found on the long side. And now you see there was a switch taking place to the short side here. That was in June. That was interesting because this was the most recent low, which was put in here from the market. And then you saw this rally, which we pointed to. And you see that into this rally, these non-coms didn't switch over or back too long, building long positions again, but shorted here into this rally. So that means this green line is going below zero now, which means they are now net short the S&P 500 here. So we are looking at the S&P 500 E-mini futures contract. So now you see that the market is trading lower from there, and then from here we now see the smart slope higher from around 200 and 300,000 contracts being net short, and now we are back to around 170, 200,000 contracts being net short into this move lower, which means they were shorting here into this bounce and now into this progression. So this move lower, this next leg lower, two new lows yesterday with this acceleration on the downside, they were taking out these short positions again. So they're trying the pure momentum or progression here, we will call this from a Dow theory perspective, on the downside. And so now we are now at new 52-week lows. And we saw this massive reversal. So first of all, now we could say, well, risk reward wise, probably we are a little extended on the downside. So taking profits here, can we really see that this is a blowout? If you look at this chart, not necessarily, but if you look deeper, then you can finally spot some very interesting developments yesterday. So first of all, this is in fact the guy I'm looking at here. So I have to open his Twitter. I forgot to look at this. That's an interesting chart from around a month ago, which is also underlining the short bias among institutional traders. So this is a chart from the 7th September of 2022, so more than a month. And you can see here, you have an idea on options and premiums, which were paid at the CME in this case for put options. So if it's negative, it's put options. If positive, then you have calls. So puts is an insurance. You can imagine a put option here to be kind of an insurance. You're buying insurance if the market drops, in this case, below a certain level, so that you're hedged below that level. And what you could see at the beginning of September was that institutions bought a record amount of in hedges. This, by the way, this is a highly recommended Twitter account, Sentiment Trader. So you should definitely, if you're on Twitter, you should follow this guy. Very, very good. Or it's not necessarily a guy, company in this case. And so what you can see here is that institutional trader net speculative option premiums in $1 billion was around $8 billion, 8.1 in fact, 8.1 billion worth of puts, and then you have less than 1 billion. So this is the sum of these two. So that's why this graph here is not at minus 8 billion or minus 8 in this case, so 8 billion. So this is because you take the puts and then you subtract the calls here in this case. And the interesting thing now is you can see that we're going back to the year 2000, and you can see that this panic hedging, which was taking place at the beginning of September, that was 3 times more extreme than the one we could see in 2008. So here, these market participants are really panicking that the market is about to crash on the downside and buying aggressively hedges here, and building hedges for their overall portfolios. So this being said, now is underlining the massive short bias we've seen taking place here. And now the interesting thing is that yesterday something just cracked to some extent. So something just happened. I mean, the inflation is coming in at 8.2. We see this sharp sell-off, and then you see this sharp reversal, and ask the question, what just happened? And if you look at what happened, then you look here at this chart, and you see there's a number we call tick. So this is giving you an idea at the NYSE. So it usually uses for short-term trading purposes. So the tick is telling you how many stocks are trading with an uptick at the NYSE. And you compare this number to or subtract the number of stocks which are trading with a downtick. So usually you see here something like an oscillating curve between minus 600 to plus 600. So what you usually do is, if you see an overextension, for example, in terms of the tick, like you're trading the S&P and then you see something like a plus 1,200, let's say. So that means that there's more 1,200 stocks trading with an uptick compared trading higher than those with a downtick. And that being said, especially if the market is extended, let's say from the volume weighted average price of 1 ATR, it's very extreme what I'm painting here, but this could mean that we are about to see a sharper bounce back to VWAP in this case. And so risk reward wise, that could be interesting for very short term traders to trade this. In this case here, we are just looking at the sentiment. We're just interested in how many stocks are trading with an uptick compared to those with a downtick. And what this guy here, this Jason Gepford is pointing to is that yesterday, after we made these 52-week lows, we saw a tick of greater 45%. So that means that around half of the stocks were trading with an uptick compared to those trading with a low downtick here at NYSE in this case, after we made a new 52-week low, which is usually, especially in the current environment with inflation being at these elevated levels and the Fed being expected to be more restrictive, even though most of this is already priced in, you usually say, well, this is a very bearish environment. And instead of really selling off, you see 50% here of stocks trading with an uptick. So stocks being bought from market participants, might be bigger institutions, funds, whatever it might be. So they're buying stocks in this environment. It's not that they're buying all stocks, but they're buying stocks. And this being said, lets you come to a very simple conclusion. And this is something he points out here really well, suggesting short covering. So what we get to see here, the main reason for that is that market participants who are betting on the market to really crash, for whatever reason, they are now starting to cover their short positions, which means that we are probably about to see a capitulation, or having seen a capitulation on the downside after this inflation print. Same could be seen, that is not happening that often, as you can see here. So we're going back for the last 25 years, and you can see the last times it happened, you can see it here with the red dots, which are pointed out. 2009 in February, that was shortly before the rally started, respectively in March, shortly before we found the lows and then took off. In 2011, here in 2016, another time in 2016, so very short, that was, let me just think about this. I think that had something to do with China. It wasn't Trump, if I'm not mistaken. So Trump was in 2016 at the end of the year. So whatever was there, you can see that was the low. Then you saw a similar thing happening here in March 2020. So that was around COVID. Well, and now we're probably seeing another sharper reversal from here, markets taking off, or at least we have put in an extreme on the downside. So long thing short, if you see such a short covering happening, and if you combine this with the information that there is a massive amount of market participants, skepticism, fear that we are about to really sell off, that there's no support inside as long as the Fed is not aggressively losing its monetary policy approach. So all the skepticism, which has a solid fundament, if you see now the skepticism diminishing and market participants starting to buy back who bought this short position here, and you see this sharp rally, well, the likelihood is that we're about to see further short covering taking place. So right now we're coming in now. So we're 10 minutes into trading day. So we are currently trading around 11,000, a little higher here in the NASDAQ. You can do the same when looking, for example, at the S&P 500. Same thing is true. You can look here at the DAX, for example, also trading around its daily highs, again, above the highs from yesterday. So that being said, coming back to the NASDAQ in this case, I would go as far to say, well, as long as we can hold here, this region, speaking with a round number, 11,000 points, I still see enough demand in the market based on the need to cover shorts in this case, that I could imagine the market to rather soon later push higher from here, and then taking out these most recent highs around 11,100 and continue to go on the upside, which means that we have minimum potential for this cover rally, let's call it, to push us as high as 11,600, probably even higher than that. And we are probably about to push significantly more aggressively above 12,000. And all this given by the theoretical idea behind inflation in this current environment, and what we can draw out of this. So inflation picked up significantly. Market participants expected the Fed to be more aggressive, more restrictive, monetary policy-wise. That has driven us significantly lower over the last 9 months. And now, price action suggests, given what we've seen yesterday, that that market participants expect inflation, which has finally peaked, and finally peaked. Let's see. I'm not sure. I can't foresee the future here, but price action, at least what market participants make out of what we got to see, and I expect them to be more well informed than I am. That here in this case, they expect inflation to having seen the peaks, at least for this year. And that being said, and then looking at another very interesting indication, the Fed watch tool in this case, and what the Fed is expected to do. This is then a potential driver for further gains if we continue to price out the more restrictive monetary policy approach. What I'm talking about, well, right now you can see we're at 300 to 325 basis points. So in November, we expect the Fed to hike by another 75 basis points. The same is true here then for December, another 75 basis points. You can see 75 plus 75 is 150. 150 plus 300 is here for 450 to 475. Still, this is just 66%. Once we start to price this out, this could be another fuel to the fire and push equity prices significantly higher. And 450, 475, even if we are coming out at 450, 475, I just project or look into the future. What is the market expecting here in June 2023 in terms of the rate level or the Fed funds rate? And we can see 475, 500 basis points with a likelihood of 70%. So all these columns being added to this one. So 475 to 500 means if we close the year at 450 to 475, in the first 6 months, the market right now is expecting the Fed to hike rates only by 25 basis points, which is already showing us that we probably found the peak in terms of rate hikes here too, which is then something which is taking some pressure from the market and also adding fuel to another rally on the upside. And by the way, so this is June. Let's have a look here at December. In December, you can see 450, 475. So if we hike another 25 basis points for 75 or 450, 475 to 475, 500, we expect the Fed with a likelihood of more than 50, nearly 60% to cut rates in the second half of 2023, already minimum at 25 basis points. And since we are looking into the future here, we're not trading the present, but what to expect in the future, and a more looser monetary policy approach, beside the fact that we don't exactly know what inflation will do, but that what we certainly know is that the Fed has a dual mandate, and it's also about the economy and making sure that we are not seeing a deep recession in the US and trying something against this, which means lose a monetary policy approach. That being said, I could expect, even if inflation is trickling down, coming down to something like 5 to 6%, but not coming lower than that, that this is at first glance or at the first step, it's enough for the Fed to say, okay, well, now we have to lose monetary policy again to somehow revive the economy and make sure that we're in the current environment also, and the potential clash with another giant in the East, then with China in this case, that we can keep a level where we can how can I say that where China confronts a direct competitor in this case, and not a competitor which is already lying on its feet and or lying on its back, and then the economy is completely crippled. So that being said, that's something to probably keep in mind in this case. So long thing short, right now everything points to a potential rally here, which is initiated from short covering. There's massive overhang in terms of short positions, which makes it likely that this will continue. So any buyer which could step in, which would be a cover rally or an initiator of a further rally, is potentially driving us as high as 11,700 probably next week already to 12,000. I'm very skeptical about markets again pushing significantly lower and going for these lows. If this happens, well, that would that would probably really result in a massive panic move. But right now I favor the short covering rally to continue in the days to come based on these inflation data. And so that's it. I hope you enjoyed the webinar. And if you have any questions, if you watch this now on YouTube, please feel free, the recording, please feel free to leave a thumb up here, subscribe to the YouTube channel, but also ask your questions in the comment section below. And all I can say is talk to you again next week. I really look forward to it. Have a nice weekend. Enjoy yourself, and happy trading. Watch your stops. See you next week. Bye-bye.